Adventures in Supply Chain podcast is pleased to present this video episode of the Coronavirus and Supply Chain series with Tristan Fletcher, co-founder and CEO at Chai. Tristan applies state-of-the-art prediction methods from the machine learning artificial intelligence academic community to real-world problems. Tristan has done this at senior levels in prestigious organizations in asset management, Aspect Capital, $7 billion, trading, UBS, $500 billion, medicine, Imperial College London, supply chain management, Unilever, and even fine wine pricing. In this episode, we talked about the following. What are predictive analytics, artificial intelligence, and machine learning? How are they different from traditional data science? What sources of data should companies use? How can companies actually use data for better decision-making? What is the importance of getting more accurate predictions? How can we see this in the financial statements? What is the impact of COVID in the use of data? For a company that wants to have a more data-driven supply chain, what would be your advice? Where should they start? This episode is sponsored by USM Supply Chain. USM stands for Unstoppable, Scalable, Mindful Supply Chain. Check us out at usmsupplychain.com to scale up your profits together with your supply chain. And now with you, your host Marcia, and our amazing guest, Tristan Fletcher.
Good morning, Tristan. A pleasure to have you on the show. Thank you for joining us today.
Nice to be here. Thank you very much, Marcia. I'm excited.
Yes, and today we are going to talk about one of the most exciting and hot topics, that is data. So to start, could you please tell us about your company? Because all companies solve issues. So how Chai is helping to resolve, and what issues is resolving?
That's a very important question, as you say. So we're helping companies choose when to hedge out raw material price risk, how much and how. And we also explain what's moving the market by summarizing the data that we feel is relevant, describing how relevant it is, and then describing what it's saying as a story.
Yes, no, that's great. It's as we want, right? We try to have our supply chain, our companies driven by data.
Yes.
So that's an excellent point. And to start digging into that, we have heard some terms, because we always hear about data, but then we also hear about different terms. So if you could help us to understand, for example, we have predictive analytics, then another one, of course, artificial intelligence, and then machine learning. So if you could help us to see what they are, that would be great.
Of course. So I'm going to be a little bit snobby and say that I don't think predictive analytics means anything at all. It feels to me like a management consultant who has just joined together promising sounding words for the sake of advertisement or better PR. AI, or artificial intelligence on the other hand, seems to mean too much to me. It's quite an esoteric, less clearly defined way of describing systems that learn, interact with their environment, but also extends all the way to more old-fashioned views of artificial consciousness. But what does have a clearer definition is machine learning. And that's a more pragmatic, application-based offspring of AI. It can be divided into different genres, but perhaps the most popular is supervised learning. And that's building systems that learn to make associations after being trained in some way, that allow them to generalize from that training and make associations on new, unseen data. One phrase that I like is AI is done in PowerPoint while machine learning is carried out in Python. And that's what we're about at Chai, actual machine learning in real Python code.
So your company uses machine learning. So if I understood correctly, machine learning is the practical application. that is what the companies can be using to, as you mentioned, to analyze the data and to find new dimensions of that data or new information, right?
Exactly. That's exactly how we see it here. Yes.
Great. And what kind, so we understand better, what kind of problems, for example, we can see addressed with machine learning in planning, for example, or logistics? How can we see that?
So actually, I got into machine learning about 20 years ago when I was working in supply chain, and we were trying to choose where to place supermarkets, where to place factories that would service those supermarkets, etc. And you get these quite complicated optimization problems where you're trading off labor costs, transportation costs, etc. And they're analogous to the kind of problems you get when you run a factory. If you want to sequence the optimal ordering of production with some constraints and changeover times, etc., machine learning is used to solve those sort of problems, extending all the way to maybe demand forecasting. So a lot of ERP systems have demand forecasting, stock keeping unit inside them. Machine learning is very useful there, where they trade off obsolescence, cost of stock outs, working capital requirements. So it's useful a lot in supply chain and manufacturing. And obviously the innovation that we have at Chai is not just forecasting an organization's demand, but let's forecast the cost of its raw materials coming inside and see if we can help them hedge out that risk, choose the best times to buy or sell their raw materials or their stock, and help them understand the drivers of those decisions.
I see. Very related to finance too, like to...
It very much is. And actually, we feel like we have taken tools that finance was using and brought them into organizations where people have physical risk. So a lot of us in the company used to work in finance. I myself used to work, after working in manufacturing, I went into financial services, into banks and hedge funds. And they have very sophisticated tools, which they're using to speculate. And we feel like we're taking those tools back into the manufacturing companies, who are the other side of those deals of the people they're speculating with.
That's great, because sometimes what I have seen is that there's a challenge to see the results of an implementation. Because when we talk about machine learning in supply chain, we always talk, of course, we can be improving on time in full deliveries, and we talk about those metrics, but sometimes it's challenging to take the effect of those metrics on the financial statements.
Yes.
So in your cases, it's clear how to predict and to anticipate. So what are the differences of applying machine learning, like Chai is doing, instead of applying the traditional use of data?
It's a good question. And actually, I think a lot of machine learning is just old statistics with better publicity. And there's a lot of people capitalizing on all these new terms when it's the same old tools being surfaced. There are a few differences that cheap computing power and cheap data storage have enabled. So we're able to look at some very interesting data sets, like satellite imagery or freight data, the movement of boats. And using old style analytics is very hard on those unstructured, image-based, for example, data sets. You can't use tools that were around 20, 30 years ago. So machine learning really brings to life the story that's inside those data sets. It tells us that that copper mine in Chile is very active at the moment because we can see the volume of the cone from the sky getting bigger and bigger each week. It tells us there's a lot of port activity at the port of Shanghai, carrying in aluminium, etc. So that kind of picture is very hard to paint without new machine learning tools. If you look at more traditional data sets like previous prices, which have a lot of information in them, and people can draw trends. You don't need machine learning to do that. You can just draw it on a piece of paper or use Excel. So it's really the newer data sets that are a little bit more interesting. We call them high dimensional, which means there might be lots of things you can look at the same time. A picture is very high dimensional, clearly. And those high dimensional data sets that might be noisy, again, satellite imagery, you might have cloud cover on it. And that stripping out the noise or knowing how much attention to pay to each observation is very important. And that's something we do with our systems.
Yes, I see. And related to that explanation that you talk about, for example, about the noise of the data. So sometimes for the companies, it's challenging to identify what sources of data to use and what sources of data is relevant for them. Because we see data everywhere now because of the low cost of keeping data, right? For the data storage is low. So how can companies know about that?
It's a very good point. And that's the interesting side effect of this explosion in alternative data. It used to be impossible to go and get satellite images unless you were the American government. Now, anyone can get them with a little bit of effort. The downside of that is, where do you find the needle in the haystack? Where do you know where to look? And so you need expertise. You need expertise that are not typically found in manufacturing companies. People who are good at transforming a raw material into a finished product are not typically the best people to know which mines are the most active in Chile for copper, which places to look at in Australia for bauxite. I would say this because it makes my company sound more important, but you need a third-party service that has done all of that effort for you, who has decided which data sets are relevant and how to make sense of them. Having said all that, the honest truth is there's a lot of information in simply looking at previous prices as well. And it's surprising how much information is in there. And there's a lot of hedge funds out there making an awful lot of money just at drawing trend lines. And that is a surprisingly effective technique. So we see ourselves as being able to do that, plus using all the unusual information that companies need to get their hands on. But a company out there who wants to be better at predicting commodity prices can do the first bit just by looking at whether prices have been historically, and maybe taking into account seasonality. In some markets, particularly energy markets, there's very strong seasonality. There's times of the year where the prices just go up. There's times of the year when they just go down. There's even days of the week where prices are higher than other days of the week with surprising frequency.
Yes, because I have had that challenge, as you are saying. In some cases, like when we negotiate contracts that cover over a year, we need to put some index for pricing. If not, we don't know because then the supplier can come back and say the raw materials have increased. So we need to put some index to know how the price will vary. And in some cases, there's not a very good one. We choose a similar one.
Right.
So it's important to find the right data sources, something that is representative.
It really is. And actually, it's better to know that you have no information than to concentrate too much on a data set that's spurious, and then you start making decisions on effectively random noise, or and people forget their humility. They need to know how serious or how strong to take the story the data is telling them, and that's something we try and do here at Chai. Like, sometimes we're very confident about what the data is saying, and sometimes we have less confidence. And the danger is that people take too much faith from a strong price trend. For example, aluminium at the moment has been going up and up and up and up. we have a view as a company that it's going to go down. But a lot of other people just assume the trend will carry on going because they're not looking at all the other data sets that are saying actually the price is going to go down. And well, we'll see. I guess listeners to this podcast can then see if chai was right and aluminium did go down, or we were completely wrong and it carried on going up. But there is a danger when a data set appears like it's got a lot of truth in it, and you're ignoring all the other data sets.
Yes, because it will depend on what you are looking at. And talking about that when you compare your predictions against actuals, how are they? Like similar?
They're very good.
Great.
Very, very good. And we get accuracies of like 99% when you look at the deviations between our prices and what transpired in some markets. What's interesting about our forecasts as well is that they get better the further out we look. So we make predictions between 1 week all the way out to 6 months into the future. And in most of the markets we look at, our 6-month forecasts have higher accuracies than our 1 week forecasts. And the reason for that is the data sets we use have really good long-term forecastability. If we look at an open cast mine, and you think about the journey a bit of metal takes when it's stuck in the ground, extracted, whatever, put on a boat, taken to a warehouse, and then is traded eventually. That's a very long journey. We're seeing that information right at the beginning of that journey, and then it may take 6 months before it's borne out in price action. So it's a consequence of the data sets we look at that we get actually quite high long-term forecastability, and that makes us very useful for people who are in procurement or in the manufacturing industry, more maybe than it does hedge funds and banks, which might have a shorter term focus.
Yes, no, because we tend to think that the shorter the time that you are predicting is going to be more accurate, but that is not the case.
It's not the case. Yes. You actually get noise. We call it noise. You get noise, so there's volatility at shorter time horizons. If you come back and you just look at daily, it's very hard to know what's going to happen because you can't see the trend that's forming.
Yes. No, that's great. And how can the companies take advantage of that? Let's say that they are getting the predictions right, like in 6 months. How can they improve their supply chain or their manufacturing operations?
So there's a few ways. One is if they have some flexibility about when they may buy their raw materials. If you forecast the price is going to go up, you buy as soon as possible. If you forecast it's going to go down, you wait. If you have a treasury team that can carry out hedging transactions, you may try and buy options that protect you against price movements. It depends on the shape of the price going forward. If it sort of goes up and then comes down in the predictions, you may try and protect yourself with a very specific options product against that. It may help organizations assist in setting prices with their suppliers. A lot of suppliers tell someone what the price should be with some fixed contract and say, we're going to supply you with aluminium for 2 years at this price. And as part of that price setting process, they've added in the cost of fixing the price. So it's like the base price now is this, and we're adding 5% to cater for any price movements. Now, companies on the other side of that deal who are buying the aluminium from the supplier don't have any idea how much they should be paying to fix the price. And we can assist with that and turn people who are price takers into price makers, and restore the balance of power. And those organizations who are buying materials through those suppliers can also explain why they think the price will move. We can say, well, it's because we're seeing inventories build up and the currency is heading this direction, etc.
Yes. No, it's a much more proactive approach and data-driven that today we don't have that. It's more related to more advanced organizations. So if a company, because wants to become more data-driven for their supply chain, where do they start with this? Because they may feel like overwhelmed and they don't know the starting point?
I think it's a very good question. I think the best place to start, as I said, is literally looking at where the price of that raw material that you might be trying to forecast has been before. Start with the simple data because it has a lot of information in it. But don't get fooled too much by strong stories because sometimes things reverse. And then this is an obvious point, but it's reading and getting background knowledge of the thing you're interested in, having context. There's a lot of stories now around companies that do automatic machine learning, where you just throw some data at some system and it tells you what the data is going to be doing in the future without any understanding of whether the data is to do with commodities, whether it's medical data, whether it's information on sport. And when the system doesn't have domain expertise, it's useless. The kind of issues we're talking about, which might be forecasting demand or cost of raw materials, there are very peculiar things about those markets. And if you don't have an understanding of them because you've been working in them, maybe you read the Financial Times, The Economist, all those publications, you've been, maybe a trader in the markets and those things. Without that knowledge, it's quite hard. And you shouldn't trust any data source really without having some background knowledge. That's the most important thing. And then, the obvious thing to do is go and get, access to a system like ours, which sort of helps you navigate that data and encourages you to probe and ask questions. And that's the thing, encourages the curiosity of someone using it and enables it so they can drill down and find what's driving anything that's surprising to them.
Those are great points because, yes, without having the right data, there's no point in having like machine learning because it's going to process that data. Yeah. So, yes, you mentioned that analysis, that knowledge to see what you are including, right, for machine learning to work. So.
Yes. And as I said before, a little knowledge is a dangerous thing. And it's better to have, I guess, no data and have the humility to realize you have no idea what's going to happen next than have a false belief based on something that's spurious. That's really dangerous. And we've seen, not just in manufacturing, and in many companies, people have made assumptions that were erroneous and they've got in trouble.
Great. And Tristan, in your view, is this a good moment to start implementing this use of the data considering the pandemic? Because sometimes we say we never expected this. And what's the point in predicting if it's going to change completely?
That's a very defeatist way of looking at things, that, we've had this horrendous pandemic and it caused all these changes. In our mind, it's a horrendous human catastrophe. Okay, I'm not going to question that, but it's increased the need for what we're doing because commodity prices were not very volatile. If you look at aluminium, it didn't do very much. There was a little bit of a blip, and there were some sanctions discussions in the Americans, the Russians, and the UK to a lesser extent. But over the last year, it didn't do much. And then COVID happened. And with all markets, the energy markets, the metals markets, etc., huge volatility. So people suddenly realized they needed to do something about it. Now, the point you're making is, well, surely you're not claiming you predicted COVID. And we didn't. There is no way anyone has a crystal ball and can say, right, there's this massive global pandemic any more than they can predict when terrorist attacks happen or other things like that. But the truth is, you sort of know after something like that's happened very quickly what's going to happen next with a system like ours. So once COVID had happened, once we were looking at the price of oil, once the Iranians attacked the Saudis and knock out supply, we were very good at forecasting what happens next and explaining the uncertainty of that. And I think that's all anyone can do, is to know that they don't know what's going to happen next, but with some information, they have an idea if the situation carries on reasonably normal, what the spectrum of possibilities are. And then once in the blue moon, when crazy things happen, they very quickly adjust and they feel like they've got all the data that they possibly could have. It's just about knowing where that boundary of knowledge is. There's things you'll never know. All the things that you will have any possibility of getting hold of and will know, we have. And that's where we feel like we come in. The other thing that COVID did is it took all those alternative data sources and it popularized them. You know, I think before, most people outside hedge funds and banks and a few other peculiar use cases weren't used to seeing graphs of traffic or public transport usage to describe the state of the global economy. With now everyone is used to seeing graphs of saying, well, this is how many people got on the London Underground before COVID, and this is how many people go on it now, and this is how much busier the world is, etc. And it sort of popularized all these different data sets, and it's thrust alternative data into the limelight. So it's kind of been an advertisement for alternative data for a lot of organizations too, COVID, in my mind.
Yes, and all very interesting points. This has been a great conversation. So thank you so much, Tristan. And what is the best way to reach Chai for those companies that are ready to have a more data-driven supply chain?
Thank you for that question. So the best way of reaching us is to look at our website, which is www.chai, C-H-A-I, predict, Predict.com, all one word, so chaipredict.com. Check us out. We've also got a LinkedIn page where we're constantly giving updates on what's happening in our world and showing our product that we're developing.
Perfect. And thank you so much again. This has been very helpful. So we really appreciate it. Thank you so much, Tristan.
Thank you, Marcia. I really enjoyed talking to you. And look forward to listening to the podcast when it's out.
Of course. Very soon. Thank you so much.
Thank you. Bye-bye.
Thank you. Bye-bye.